doing
chat.
that. Thanks, Laura. I appreciate it. And hey, Mark, hey, it's been a while. Lance, how are you?
Hey
Hey,
guys,
hey.
I
Good to
noticed
see you.
the champagne belt draped dramatically across his shoulders.
Yeah, it weighs so much that, my shoulder's getting a workout holding it.
You gotta lean. You gotta lean. You won that at Blitz versus Burn, I take it?
Yes, in front of the millions and millions of fans. No, on Ford stock, I caught about a 5% move, whopping 5%.
I'll take it, right? So excellent. There's the link to Roger's VIP trade room. And in fact, because the trade room is now going to start at noon, we're actually going to move up roundtable for the coming weeks. Instead of being at 11:30, we're going to start at 11 a.m. going forward. So just a quick reminder for next week, we're going to begin at 11 and every week thereafter. But we'll send you reminders like we always do. So we'll get things going. To get us started, since August 16th, the market is down almost 10%. The NASDAQ, we're looking at the longest losing streak since 2016. Some of it's likely due to the Fed's more hawkish tone lately. The expectation is now a 3/4 point hike. Plus, we have the big energy crisis brewing in Europe. Thank you, Russia. So, Roger, what do you reckon? What's happening with energy? What do you think? Talk to us about it.
Well, specifically about energy, I think energy is right now between a rock and a hard place because while we have inflation and inflation is not going anywhere, if inflation peaks just a little bit more, we're going to get into a recession. If we're going to be in a recession, it's not good for energy. So it's kind of like too much of a good thing, maybe. It's not so good for the market. So it's a very delicate balancing act. And it's interesting that you mentioned energies because today or yesterday, for the first day, energies are actually trading below the swing high that was made when the war started, when the Ukrainian war started. So we're actually declining below those levels. And I think that's happening because there's an increased risk that we are going to go into a recession. Now, I'm not suggesting that is the case, but that's what the sentiment right now with the energy market is. So right now with energies, what you really have to focus on, not so much supply and demand, but you have to focus on whether there's a higher chance that we're going to have inflation, which is obvious, or if that inflation is going to turn into a recession. And that's really the crux of what energy is up against right now. It's a very different situation than the rest of the market. It's kind of doing its own thing, and it's usually doing its own thing. It doesn't have a strong correlation to the rest of the market. In my opinion, we're still too far away from a meaningful recession. We still have to see what the CPI and the PPI numbers are next month. If those numbers confirm that inflation has peaked, then there's a higher chance that the Fed will start backing away from that 0.75. And if that happens, then energy will have another spike. But to think right now that energy have given up and that's the end and they've peaked out, that would be a very, very foolish move at this juncture in the game, especially with the market trading below the 200-day moving average, with the economy suffering. So I think energies have more to go.
Okay, I'd be curious to hear what you think about the markets, recessions, energy.
Yeah. Oh boy. It's a crazy market. And I have to say, I have my thoughts and opinions, but Roger's probably a lot better than I am on this sort of stuff because he's much more versed on this than I am. But I look at this like energy for a while was doing so well when tech was beaten down, energy was going higher. Then we saw the reverse where tech started to rally and energy dipped. And now we're kind of in that mode where they're both going down and they're both kind of ugly. So I was using energy as my sort of my inverse, right? I was bullish on energy when tech was tanking, and now we don't have that go-to. But energy is weird because we've got, what's going on in Europe and decreased supply. OPEC came out and did the opposite of what Biden asked. He asked him to produce another 100,000, and they decreased by 100,000. So if that wasn't a little slap in the face, right? So there's that. I think I was just looking just briefly, decreasing demand in Asia, China at least. I don't know if that, and probably for us even here, I don't know. Summer usually higher demand. I guess we go to heating. It could, bump that up a little bit in the winter. But it's it's weird and it's not making sense. So when things do that, I go right to the charts. And so I'm like, I look at recession. I'm kind of the opinion, I think we've already been in a recession. Now, might be wrong. I feel like it's one of those things that down the road, they're going to come back and say, oh yeah. Remember when we had high inflation, we actually were in a recession, but now we're out of it. Like I can see, you see that happening, right? So I think everything is weird. The economic numbers aren't great, but also our markets are so resilient and traders are always trying to get ahead. So I think we're getting close to the point that all this stuff is priced in. So before we find out that, oh yeah, we officially are in a recession and now we're officially out, markets are going to be moving higher by then. If you're waiting for the Fed or whatever government agency it is to come in and say, okay, yep, now everything, we're in the clear, we're good to go, now's the time, you will have missed all of the momentum. You've missed that move. So a lot of things that is throw at you, but I kind of just think for me, it's a really important time to look at the chart and see where there are levels where you have buying pressure, where you have selling pressure, and follow that at least for the short term, because it's weird and it's probably going to continue to be weird with all the, every other day different news and pressures and whatnot.
Yeah, I think that's good advice. Focus on the data, not on the news. Would you agree with that, Lance?
Yes. I mean, you got to figure it. Your goal is to make money in the markets, not to call, recessions and worry about economic numbers, right? If so, go get a PhD, become a economics professor, and have fun, right? Like Marquez said, by the time they come out with the recession word, markets are already going to move, right? So you want to be proactive, not reactive. So, I mean, to be honest, I don't look at any of these numbers anymore. I don't care. Kathy Wood said we're in a recession a couple months ago. I believe her. She's a smart girl. She's only down like 60% year to date. So
where are you seeing order flow? Like what sectors are you seeing that are hot right now and what are depressed?
Woof, that's a good question, because order flow has been still amazing in terms of trading, but in overall market participation, just nobody's trading the markets. And you could kind of see with the low volume and the choppiness. We've been seeing a lot of funny business flow, like a lot of pump and dumps and the speculative names, which are not fun. So I've been avoiding that. But today we've actually seen telecom. So very boring, very low beta. The stocks usually don't move. Like I just closed out a trade in Verizon, made about 30% overnight. The stock was up like a little over 1%, but the options moved that much. They're actually marking about 47% from the close. But names like Comcast, Verizon, just your boring kind of, obviously the charts are all horrendous. All these names are at 52-week lows just about. But boring stocks, if you look at McDonald's today, you look at Pepsi, look at Coke, there's actually been some flow in those names as well. You're not seeing like your Nvidias, your Apples, your Metas, your AMDs. Just there's really no one participating in those stocks that usually have high option volume.
Are you seeing that too, Roger? I see a nod.
Yes, absolutely. Lance is absolutely right. Well, a very low volatility in the big caps, not a lot of interest. Also, some of that is due, in my opinion, to the fact that it was a fragmented week. The week didn't really start till yesterday. A lot of people are still coming back into the market, and the fact that we've had so much downside. So I think it's a combination of buyers they don't want to be the first to dip their toe in the water, and a lot of the fund guys still haven't come back from their holidays. This is the last hooray of the summer. I mean, we're, the fall's about to start. I mean, I see it around here. People are trying to get their last trip to the parks, amusement parks, traveling to see their relatives. So I think anytime you have a fragmented week, I don't really start looking at the market. I almost look at the market like it's a short Friday for the first day or two. So I think today, maybe tomorrow will be really the first day we're going to start seeing real volume. But I agree with Lance. I'm looking at a lot of these stocks, and even though the market was up, the Dow was up about 200 points. None of the stocks I was long or short really were the big caps were really feeling it. So there's just a lot of wait and see right now. Also, this week doesn't have a lot of Fed data, so I think a lot of investors and traders know that September is not historically a very bullish month. Historically, we're down about 4.6, 4.8% in September. So I think people are very scared. But I actually am becoming increasingly bullish in light of everything that I'm seeing. But I think it's going to take, as I said, a few days or maybe 3-4 days for people to start kind of feeling that bullishness or feeling that the bears have kind of dissipated for the time being.
And you have a lot of events. Roger mentioned the Fed speakers this week, but you start having conferences, events. You have the Apple event coming up, which, is something. You have Verizon and analyst event tomorrow, I believe, and I think Starbucks has one as well. So you're finally starting to see, what moves markets, earnings, events like this, investor days, stuff like that, where there's some kind of projections out there. So I think, like Roger said, you'll start having people come back into the markets. It's just like, I can speak for myself. The past week or so, like, I've been going on the beach. I've been enjoying the weather. I don't want to, stand in front of the screens all day. People are traveling Labor Day. But you'll start seeing market participation coming back. And if you're bullish, hopefully to the bull side. If you're bearish, well, this could be another whack to the downside.
So we talked about the importance of data instead of emotion. Of course, emotion does drive the markets, but data really tells you what's going on. So let's talk about indicators. And that's part of the reason I chose you guys as the guests, because I know you guys are all really into this element, the indicator element. Specifically, are there things that you specifically rely on when you find to find short-term market bottoms, like we're seeing today? I'm talking about widely available indicators that you usually have up on your charts. Roger, do you want to launch us on that?
Yeah, there's a couple that I've used for as far back as I could remember, and they're actually really, really good. One of them is the 5-day RSI. I take the relative strength index. The traditional setting is 14 days. It doesn't really work that well for stocks, but if you move it to five days for general market sentiment and 2 days for entering and exit trades, that's a great indicator. Another really good indicator is using it as a divergence indicator. So using it on its own and using it as a divergence is a really, 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 really good indicator. And right now, using it that way, you're seeing 90% of stocks really getting oversold. More importantly, bonds are diverging right now. They're making new lows, but they're diverging, which is another strong sign that the market's going to turn around. Another major, just before I move on, and this is really big, is I look at the number of stocks making 20-day highs and 20-day lows. So 3 weeks ago, when the market was doing its thing, going up a lot, we had 400 to 500 stocks making 20-day high and about 20 stocks making 20-day low. This morning when I was doing my video, it was completely inverse. It was like 450, 500. Don't quote me on the number, but it was up there. And again, there was like 20 stocks making 20-day highs. So whenever you get to that extreme 20 to 1, 25 to 1, it tends to revert. So those are 3 very, very, very good tools that have worked very well for the last 30 years, and I think they're going to continue working.
Are there any that you would avoid, that you think traders should avoid? Any indicators that you think are misleading?
Absolutely. And yes, all indicators. Yes, every indicator. I would avoid absolutely every indicator the way it was traditionally made. Every indicator. If you look at most indicators like MACD, stochastics, all of these indicators, they were all created in the early 70s, late 60s, early 70s, when the word swing trading stocks did not exist. It wasn't born for 20 years yet. Nobody was swing trading stocks till the mid 90s. Internet gave birth to swing trading stocks, discount brokerages, all that stuff. It was hard to swing trade stocks when you had to call Goldman and place a trade for $300 and not know if you got filled till the next morning. So nobody traded stocks. Nobody swing traded stocks. Everybody was position trading stocks. All of these indicators were for fast markets in commodities. Commodities currencies are directional markets. They're not counter trend markets. Stocks are counter trend markets. They're very mature markets. And it's kind of like comparing a dolphin and an airplane. A dolphin goes up, down, an airplane or a bird, dolphin and a bird. You can't do that. And the problem is a lot of people take these indicators. So I like most indicators once they are tweaked. Once you tweak them, you can make them work really well for stocks. The problem is nobody really does that, and that's a really big problem. So on just as a ballpark, I would avoid the stochastics. Matter of fact, the stochastics is so bad that we created an indicator called the stochastics pop to fade the stochastics. It's just too sensitive. Yeah, no joke. So yeah, most indicators really go online when you want to use an indicator. Go online, type it in Google, and see when it was invented. If it was invented before 1995, I could promise you it was never designed for stocks, and it needs to be changed extremely to work with stocks. I'll leave that there.
That's a good tip. Okay, I'm going to save you for last because you have some exciting stuff to talk about. So Lance, I'm going to swing to you next about which indicators you like, what you like to use, and which you would avoid, and which do you think traders use and shouldn't, that it's a mistake.
Yeah, so I agree with Roger that, stocks are like sprinters, right? And commodities are like marathon runners. They trend. Stocks are up, down, up, down, up, down. So a lot of the indicators that you get free on your platform, like a MACD, all that kind of stuff out there that's free, those are reactive, right? So by the time the stock makes the move, then the MACD or the moving average, like let's say a 50 or 208, then they move, right? So you're one step late for everything. You want to be proactive. So I always think of the pimple commercial, remember? Like, I use proactive. Look, now all my acne is gone. Yay. You want to get in before. Yeah. You want to have clear skin so you don't get, zits and stuff. But I think if you're out there and you trade options, implied volatility is always good to look at. You can really forecast just option pricing, right? Historically, you want to be a seller of high implied volatility, buy a lower implied volatility. And let's say the stock has earnings and implied volatility rising, get spread out trades, you can maneuver that way. So implied volatility is one of my favorites to look at. ATRs, like a 5-day or 3-day average true range, just basically seeing how much the stock moves per day from high to low is always good, especially if you're day trading. So you could put support and resistance levels on the ATR and profit targets as well. And then what I like personally, because it doesn't lie, is volume. What moves stock prices higher? More buyers than sellers. Lower, more sellers than buyers. So volume doesn't lie, and volume is right there on your charts. I like looking at a volume average history because volume confirms the trend or confirms the breakout. So volume, I would say, just you could put it up on any chart. It's completely free. Obviously, I have my master indicator, which takes a volume average, and a daily ATR study, along with 2 fast acting moving averages. That's totally customizable. Cheap plug. But most out there, I see people using way too many indicators, like on their bottom of their screen, or like where you can't even read the chart. Which is just insane in my opinion. So like, keep it simple, don't overcomplicate things. And just, make sure you can read your chart correctly to where you still get price, you still get volume on your chart, and just don't overclug it with reactive indicators, especially, the time frame of your trading, right? If you're a long-term investor, yeah, maybe a trend study is okay. But if you're swing trading 1 to 2 days, like I bought Verizon calls yesterday. Verizon's like the worst chart in the overall market. Like, it sucks, right? On the daily chart. But if you look at it, like, let's say on a 5 or 15-minute chart, it didn't look so bad. And it doesn't look so bad today. So hope that helps. I'm, big into like system following and having some kind of guide in trading. And I think that's what an indicator should be, like a crutch to kind of give you a guide and a rule system in your trading.
Yes, I think that's well said. So Marque, I know that there's indicators I'm sure you use day to day, but I also want to hear about your bear trap indicator, something new and exciting coming down the road. But first, start with what you think people should look at and what they should avoid. How's that?
Okay, first of all, I love being with all of you guys. These two guys are so awesome right here. Everything they said, spot on. I love, love, love it. So that's stated first. One of my favorite indicators is the Bollinger Band indicator, but kind of like Roger says, I actually took John Bollinger's class. He's the guy that developed it. And I use it exactly opposite of how he even uses it. So what I do, I use the bands only to help me find some turning points. And the thing is, it's not spot on. Like, it won't tell you today's the day it's turning, but it gets you close. And you start to see when momentum is kind of slowing and maybe where you are at a bottom or even at a top. It helps me take profits at the right time. And then it helps me find those reversals. So right now I'm watching a lot of stocks, honestly, coming back close to those COVID lows that we had, March and April in 2020. We're starting to see stocks come down to those levels. And I combine it with the bands and I look for a kind of a Bollinger bottom. And those things, support and resistance, and the bands help with that. Yeah, exactly, Roger. I love it. Yeah, that's awesome.
Now, he never, first of all, he's an analyst. He doesn't trade. He's never traded. T-Buzz met him and asked him, he's like, oh, I don't trade. So it was a big disappointment because T-Buzz really liked him a lot and he was kind of let down. This is a story that T-Buzz shared with me and many other publicly several times. But yeah, Bollinger Bands that's an amazing example of an indicator that is extremely useful if you know how to tweak it and use it the right way. But it was never designed, tested, or traded on stocks. But every stock analysis program has it on there. Bar Chart has it. And I think that's the problem. I think that because all of these programs, your brokerages have it, that people assume that if it's there, it obviously must work. Why else would you have it there? And they don't know the history of all this. And when you start explaining it to them, they're like, wait, I'm using something that was invented 20 years before the word swing trading stocks was invented. Why the hell am I doing that? Sometimes you have to kind of like give them that perspective. But most of these indicators are great if you know how to tweak them for the stock market. And it's just like Marque said, the way she uses them is the way I would use it as well. That's exactly right.
Yeah, well, let's talk. Oh, go ahead, Margie.
Sorry, I was just going to say, I think you have to, if you want to use an indicator, I think first of all, you have to use them sparingly because there are some, variation of the actual real value, which is price and volume. I mean, that's the real stuff that you can't tweak or change. And then you got to use them sparingly and test them and find something that works. And if it doesn't work, then quit thinking it's going to work someday because it's not, right? That's the thing. You just have to test it and find if it works, keep it. If it doesn't, kick it to the curb.
Right. So let's talk about how to avoid bear market traps.
Yeah. Okay. So should I just jump in and tell everybody?
Yes, please.
Okay, cool. So what's crazy is in these markets, and I find these markets, more in particular over the last year or so, we've had a lot of weird volatility, a lot of things that don't really move the way they should, right? Like you could say maybe energy should still be going higher, but it's not, right? That's maybe one example. Like it's all the time. But the other thing that is weird is that I'll see this price action and you'll see a move and it will be what normally would be a great setup, let's say for the stock, to continue lower. And then all of a sudden what happens is things reverse and the stock that really should be continuing lower, it takes off and it's super, super bullish. So what happens is people get stuck in that trap, in that bear trap, because everything looked like the stock was going lower. Call it the volatility of the markets or whatever, but things shift and change and you're caught unaware. And that's a terrible place to be, for one thing. And the second thing that's even worse is maybe you don't make money when the stock does take off. So that's what we started getting in and working on and seeing. There are weird, I can't even call them levels, just really odd fluctuations in the market. And I think it probably has to do with, what we've seen over the last, year and a half or more. Maybe it's inflation, maybe it's, who knows, whatever's causing it, it doesn't matter because I don't think it's going away anytime soon. Like go back a few years, 4 years, 5 years, for all those years, all we had to do was buy on dips and be bullish and you were golden. It's not happening that way anymore. And you've got to be more careful. And people are getting trapped, being maybe too bearish, and then you miss the rally. So that's kind of the thinking. What was going on is that these stocks are having these crazy swings, and even to the upside, you get these big bullish swings, and then everybody, maybe you'd see it, you'd love the pattern, and you go all in, and then it breaks down. And why would it break down? It wasn't making any sense. So it happens both directions. So we went in and did a lot of analysis, a lot of testing, got some programmers involved, and developed an indicator that helps us find those traps. So we started first with the bear trap, because that was happening a lot, right? So you get trapped and then stocks take off, you're losing money on the bear side. And then, like I said, you're not making money on the bull side either. So it's not a good place to be. So it was working really well. Well, if it works well one way, you got to ask, wouldn't it work well the other way? So we kind of did some testing there and found, yeah, it's the same thing. So we've got this really cool indicator that finds bear traps and even bull traps.
Oh, that's awesome. So you're going to be presenting on this next week, aren't you?
Yeah, next week, Tuesday at 1 Eastern.
What's it called, Marquet?
It's the bear trap indicator.
You know what I think
There you go.
Marquet? I think of Joe Rogan just had it on. I watched a YouTube short on it. The guy's like in a, I don't know, like a glass thing, and the polar bear is trying to attack him, because polar bears, they're out there in the freezing cold. All they do is eat meat, unlike other bears, and they're like super strong. He's trying to break them out and eat them, and rip his guts out and eat him, everything. So I love the name, the bear trap.
Bear trap. I'll find the Rogan video.
So we put an invite in the chat here, and for people to be able to attend. It's free to attend. You can learn about this indicator and everything that all the research and data that Marquet put behind it. So it's
highly
Tuesday.
recommended, folks. Highly recommended. And I just want to say it's designed for this type of stocks that we're trading, not for commodities, not for futures. It's for what what Lance is doing, for what Marquet's doing, what I'm doing. Sorry, Laura, I didn't mean to interrupt you. Just wanted to.
Not at all. Not at all. Go ahead.
Just wanted to say that because it's really important. Use indicators that were actually tested and committed and worked on the stock market. It's very different. Remember, counter trend market, reversion to the mean, very different from these big moves you see on currencies. I'll keep my mouth shut from there on.
No, I think you're absolutely right. And I think that education like this is really important. Data-based education in markets like this, I think it's the perfect time for you to do lessons on that. So Tuesday, 1 p.m.
Yes.
You guys just click on that link in the chat and sign yourselves up. And 2 minutes to go. Lance, tell everybody about your belt one more time, because people are still asking.
Yeah, people are asking about that.
I'm just about to send a trade alert. I was typing because one hit, and I'm such a junkie. I'm trading while I'm on a show. So I'm a one-time trading champion. I don't have 10 of them, but I have a belt, so that's more important, right? Sorry. But me and Jeff had a competition in Jacksonville Beach, and he thought he was getting lucky with AMD. The market was up pre-market. AMD was up like $1. I had forward calls. We both did weeklies, and Ford held a bid at the open. It was up over 1%, which was actually good considering the market was tanking. And Jeff's AMD at the open went straight down, and yeah, and we kept adding like true traders all in the afternoon. So I kept buying more and more Ford calls. I think I had like 75 Ford weekly calls. So I made enough money to cover dinner basically, but I won the belt that probably cost just as much as my gain. So
and the bragging rights.
Yes, I am the one-time trading champion, and I'm wearing the belt everywhere. When I go out to dinner at night, I wear the belt, and when I go to valets and travel, they go, "Oh, champion, please let me grab your bags."
Lance is holding it for what it's worth for everything.
Yeah, absolutely.
Literally.
Well, thank you all for joining us, Marquet. Everyone's saying you have to come back, so I hope you'll join us again.
Yeah,
a
I
real
would love
pleasure.
Marquet,
to.
great seeing you. Good luck on
Yeah,
your
good
indicator.
to see you, Marquet. And
Yeah.
Tuesday,
Marquet,
1
when are
p.m.
you going live again?
Tuesday, 1 o'clock, 1 Eastern, next Tuesday.
Perfect. Lance and I will make sure to tune in on that. That's going to be
I
very,
would love
very
it.
good. I'm going to
So
put
good
it in
hanging out
my.
with you guys. I miss seeing you. And Lance, I'll see you in Tampa someday. We'll go out to dinner. Only if you'll wear the belt.
We'll
Oh,
get
there's
the
a
good
challenge.
table with
Bye,
the belt.
Roger. Thank you. You guys, if you
Bye,
want to
guys.
join him, that link
Thanks,
to
you
the
guys.
VIP trade room is in the
VIP
chat.
room, come on in, guys. We're going in there right now.
Right,
Bye,
you can go
Marquet.
there.
Bye, Lance.
See
Bye,
ya.
Laura.
Free
Roger.
invite
You
to
guys
join
next week.
Roger.
Bye.
See you,
And
Marquez.
another
Roger.
invite to Marquet's
Tuesday, 1
room
p.m.
on Tuesday, 1 p.m. See you then. Thank you so much.